Hello viewers, welcome to my channel. I'm Hashim Ali Khan. So right now I'm giving the lectures on the subject income tax for the assessment year 2021. The last video I have given the introduction to the concepts of direct and indirect taxes and what are the basic concepts of income tax. Now I'm going to start. I have discussed about the characteristic features of tax, what are the objectives of tax, then what are the different types of taxes. All these things I have explained in the previous video. So if you have watched that video, you got some basic things regarding income tax. If you have not watched that video, I suggest you, before proceeding ahead, go to the playlist of my channel, select the subject income tax for 2021 and first video you watch completely, then definitely you can be able to understand the second video, right? Now I am continuing the previous one, basic concepts of income tax. Under Income Tax Act 1961, we come across a number of concepts which have technical meaning to it. So a person must know what is the meaning of the term according to Income Tax Act 1961. So presently in India, the Income Tax Act 1961 will apply throughout India for purpose of imposing the tax. Now, basic concepts which are used under Income Tax Act are, first one, SSC. Very frequently we come across the term SSC. SSC means a person from whom any tax or any other sum of money in the form of interest or penalty is due to the income tax department, or a person against whom income tax proceedings has been started either for the assessment of his income or the income of any other person for whom he is liable to pay the tax, or if any refund is due to that person. So this is the meaning of the term SSC. Again I repeat, the person from whom any tax or any other sum of money are due to the government in the form of interest or penalty, or a person against whom income tax proceedings has been started by the Income Tax Act, whether on his own income or the income of any other person for which he is liable to pay the tax, or a refund of tax is due by the department to the person. That person will be called SSC. Now, person. Second one is person. In ordinary language, the person means a natural person. We are all persons. But from income tax point of view, person does not mean only natural person. Even artificial person will also come under the ambit of person. The person includes natural person, we are all natural person. Apart from that, Hindu undivided family is a person. Then partnership firm is a person. Joint stock company is a person. An association of persons or artificial juridical person. All these are persons according to Income Tax Act. Then we have previous year. A previous year means a year of 12 months, a period of 12 months immediately preceding the assessment year. It begins from 1st April and ends on 31st March next year. The income earned in the previous year is chargeable to tax in the assessment year. For example, the current assessment year is 2021. 1st April 2020 to 31st March 2021. This is the assessment year. For this assessment year, immediately preceding 12 months, that is 1920. So we can say the current previous year is 1920 and the current assessment year is 2021. So in simple words, previous year means a period of 12 months immediately preceding the assessment year. Begins from 1st April and ends on 31st March. So income earned during previous year is taxed in assessment year. That is previous year. Assessment year. A period of 12 months beginning from 1st April and ends on 31st March. So current assessment year is 2021. It has already started on 1st April 2020 and ends on 31st March 2021. This is called assessment year, and income earned in the previous year is taxed in assessment year. So that's why previous year is called income year and assessment year is called tax year. Next, income. The income tax is a tax on income. So first of all, a person must know what is income. If we are clear about the income, then easily we can tax the income. But unfortunately, Income Tax Act has not given any specific definition of income. But according to the rulings of the courts, the characteristics of income we got. So what are the characteristics of income? Accordingly, we can be able to decide whether it is income or not. So a number of rules are given. That means income should be actual, it should be genuine, it should not be notional. Income may be legal or illegal, no matter, every income is taxable. Income must be definite, the income may be cash, received in cash or in kind. If the income is received in kind, it should be converted into cash value according to the provisions of the act. Like that. Income should be generated from outside. The income which is generated within the family is not an income. So, number of characteristic features are given regarding deciding whether a receipt is income or not. Remember, every receipt is not income, but every income is a receipt. So we have to decide if it is a receipt but not an income, there is no tax at all. For example, a person has taken a loan from bank. A loan from bank. That means when he has taken the loan, it is a receipt, but it is not an income. It is not an income. So all receipts are not income. If it is income, then only it will be put to tax. Then permanent account number, PAN. It is a number allotted by Income Tax Department to the SSC for easy identification. So the person whose income exceeds the basic exemption limit will apply to the assessing officer. The assessing officer will allot an identification number, permanent assessment number, PAN, permanent account number. So this PAN number will be allotted to the SSC for easy identification, so that whenever a scrutiny, investigation has to be made with the help of PAN number, this PAN number, by using this PAN number, we can be able to find out the details of that SSC. The next one is average rate of tax. The average rate of tax we can get by dividing the total tax. First we determine how much is the total tax of the SSC. The total tax divided by total income into 100. If you find out this rate, this is called average rate of tax, and this average rate of tax will be used for calculating the advance tax to be paid. These are some of the basic concepts which are used in Income Tax Act. So now agricultural income. The next topic I am going to discuss is about agricultural income. See, in India, there are different special provisions for taxing the agricultural income. According to section 10 subsection 1, the agricultural income is fully exempted from tax. However, it will be included with non-agricultural income in order to find out the tax on non-agricultural income. That means if a person is having only agricultural income, it is completely exempted under section 10 subsection 1. If a person is having agricultural income and also non-agricultural income, then both incomes will be combined together to find out the tax on non-agricultural income. That is the right present provisions under agricultural income. But agricultural income is exempted under section 10(1). So how? First of all, which income is called agricultural income? The Income Tax Act has given 3 conditions. If the 3 conditions are satisfied, then that income will be called agricultural income. First one is rent or revenue should be derived from land. Rent or revenue should be derived from land. Second one, the land must be used for agriculture purpose. And third one, the land must be situated in India. If these 3 conditions are satisfied, then income will be called agricultural income. If any one of the conditions is not satisfied, that is not agricultural income and it will be taxable. First one is rent or revenue derived from land. Rent derived from land. For example, an agricultural land is there. The owner of the agricultural land has let out the agricultural land to another person, to farmer. The farmer is doing agricultural work. And from the agricultural produce what he is getting, he is paying the rent to the landlord. The rent received is also agricultural income. He is not doing, the landlord is not doing agricultural activity. He has let out the land to another person. The other person is doing agricultural work, and from that revenue he is paying the rent. The rent is an agricultural income. Revenue means actual agricultural operations performed and received. For example, a farmer. A farmer has done all agricultural operations. He produced the agricultural produce. He sold the agricultural goods and get the revenue. That is called agricultural income. The rent or revenue derived from land. The land must be used for agricultural purpose. Second condition. The land must be used for agricultural purpose. So what is agricultural purpose? Normally two types of activities are performed on agriculture. Basic operation and subsequent operations. The basic operations are the digging the earth, cultivating, sowing the seeds, watering the plant. These are called basic operations. So any income arrived from basic operation is agriculture operation. Subsequent operation. The subsequent operation are the operation activities which are performed after the seeds are sprouted, after the plant is sprouted from the earth. That means after the plants are grown up, harvesting or fertilizers or insecticiding, all these activities which are performed after the sprouts, after the plants has been raised. So the activities which are performed after the plants are raised are called subsequent activities. So if a person performs basic operations and subsequent operations, then all the revenue derived from basic and subsequent operations are called agricultural income. Suppose if a person performed only basic operation, agricultural income. If a person performs only subsequent operations, not an agricultural income. Not an agricultural income. That we have to see. So in order to decide whether it is agricultural income or not. Thirdly, land must be situated in India. The agricultural income should be derived from the land within Indian territory. Suppose if agricultural income is derived from outside India, it is taxable in India. It is taxable in India. Only Indian agricultural income is exempted. So these are some of the conditions for agricultural income. Now, income tax rules and exemptions. See, in India, Income Tax Act 1961 will apply throughout India. Now, Income Tax Act is not constant, stagnant. The rules of income tax will change every year. So every year finance bill will be passed. In that finance bill, a number of changes, amendments will be done to Income Tax Act. Why Income Tax Act provisions will change? Because the economic conditions will change. The income of the people, the inflation, the complete socio-economic conditions will not be same. Every year it will change. So Income Tax Act should also be changed. Provisions will change every year. So presently, for the assessment year 2020-21, what are the provisions regarding the exemptions, regarding the rules? What is the tax rate? That I am going to discuss here. For the assessment year 2021, the exemption limit for individual resident SSC are as follows. See, basic exemption limit. A person is liable to pay tax only if his income exceeds the basic exemption limit. This basic exemption limit will change every year. So for current assessment year, for current previous year, the exemption limit is for individual resident SSCs, if he is a non-senior citizen. Non-senior citizen means both men and women below the age of 60 years. Below the age of 60 years, he or she will be called non-senior citizen. So basic exemption limit is 2,50,000. So up to 2,50,000, no tax will be applied, whether he or she, male or female. If the income is below 2,50,000, up to 2,50,000, up to 2,50,000, basic exemption limit, no tax at all. Over 2,50,000, when his income exceeds 2,50,000, he is liable to pay tax. For non-senior citizen, below 60 years of age. Senior citizen. Senior citizen means those persons who have crossed 60 years of age but below 80. Below 80. So 60 and above, below 80. The persons are called senior citizen persons. For senior citizen persons, the basic exemption limit is 3 lakh rupees. 3 lakh rupees is the basic exemption limit. Over 3 lakh rupees, he is liable to pay tax. Up to 3 lakh rupees, no tax for senior citizen. For super senior citizen means a person who crosses the age of 80 and above. 80 and above. Super senior citizen. For these persons, the basic exemption limit is 5 lakh. Up to 5 lakh, no tax. Over 5 lakh, it will be taxable. So we can categorize the SSCs into 3. Non-senior, senior and super senior. Non-senior persons up to 60 years of age. Below 60 years of age. Not up to, below 60 years of age. So they are non-senior, the basic exemption limit 2,50,000. Senior citizen 60 and up to 80 or below 80. 60 and below 80, they are called senior citizen. For senior citizen, basic exemption limit 3. For super senior citizen, 80 and above, the basic exemption limit 5. For non-resident individuals, if a person is NRI, non-resident Indian, so if a person is non-resident individual, the basic exemption limit is 2,50,000 only for all category of persons, whether non-senior, senior or super senior. For all type of persons, it is same, 2,50,000. Now, heads of income. Income Tax Act 1961 has given the provision how to compute the income of a person. How to calculate the income of a person. The Income Tax Act has classified the heads of income into 5. The 5 heads of income are income from salary, income from house property, profits and gains of business and profession, income from capital gain, and income from other sources. So, for computing the income of a person, we have to decide, we have to find out what is the source of income. Is it income from salary? If it is income from salary, taxable under the head income from salary. So in the next video, I am going to explain you for each head. For each of the head, one video will be there regarding how to compute the income from salary, income from house property, income from business and gains, and profits from business and gains, capital gain, income from other sources. Simply I can say income from salary will be applied for those people who are in employment. The people where there is employer-employee relationship, the person is getting the salary from the employer. There we will have income from salary. Next, briefly I am giving the explanation here. In detail, in the coming videos I am going to explain. Income from house property. A person is having some house property which is let out on rent. So the landlord, the owner of the house property, is getting the rent from the property from the tenant. So it will be taxable. The rent received will be taxable under income from house property. Then profits and gains of business or profession. If a person is carrying on the activity of business or a profession, so when a business is run, the profit earned from business is taxable under that income, profits and gains of business and profession. Some people will carry on the professional activity like doctors, engineers, chartered accountants, lawyers. So these are the professional people. So if a person is having income from profession, again it will be taxable under profits and gains of business and profession. Capital gain. If a person has transferred a capital asset during the previous year. Capital asset. What's a capital asset? An asset which was purchased by the assessee not for sale, but for use in his personal life or business life. So when an asset is purchased not for the purpose of sale, it's a capital asset. When the capital asset is transferred, the gain arising is called capital gain. Example, a house property was purchased not for sale purpose, but for usage or giving on rent. So if the house property is sold out during the previous year, gain arised, it will be taxable. Similarly, gold purchased in the past, some 10 years back, 15 years back, gold was purchased, not for the purpose of sale, but for use as an investment. Later on, during the current previous year, the gold was sold. Gain arised, that is called capital gain. It will be taxable under income from capital gain. Other sources, it is a residual head. Residual head means if an income does not fall in the first 4 heads, it will be put to tax under the 5th head. Residual head. The motto of the Income Tax Act is no income should go untaxed if it is not exempted. If it is not exempted, no income should go untaxed. A person cannot claim, a person cannot say that my income does not fall in any of the header. It is not a salary income, it is not income from house property, it is not business income, it is not capital gain, so my income is not taxable. He cannot say like that. The Income Tax Act says your income will be taxable under the income from other sources. It is open head. Any income which does not fall in the first 4 heads is put to tax under income from other sources. In this way, income tax. The detail in the coming video, I am going to explain you in detail how to compute income from salary, how to compute income from house property, income from profits and gains of business and profession, capital gain, other sources. In the coming videos, I am going to explain you all the different heads. So in this video, I have explained you the basic concepts and what is agriculture income, what are the rules regarding basic exemption limit that you have to remember. And then lastly, I have explained you about the heads of income, 5 heads of income through which income tax will be calculated. So I have completed the second part of this theory introduction. This theory part will be continued in the 3rd video also. After that, we'll start the practical problems videos. So if you are satisfied with my lecture, give a like to the video, share it in your group, in your friend circle, and give your comments, your suggestions, your feedback about these videos. And lastly, don't forget to subscribe my channel. I'll continue the introduction part in the next video.